What is business value? And that's a question that I have to address every time I do evaluation, every time I go out and look at a business and advise a seller on what they should expect to receive for their business, or advise a buyer on what they should expect to pay. So that's what this video is all about, paying the right price for a business. Let's get to work. So what I've produced for you here is a graph which demonstrates the relationship between risk and return on investment. The higher the risk, the higher return on investment you would expect. The lower the risk, the lower the return on investment you are going to get. That's a pretty simple equation. That works in almost all cases. Right at the bottom of this graph you have the category I've pulled out is cash and bonds, cash or bonds. They're pretty close at the moment as far as return. We're probably right down here. The absolute minimum risk and the absolute minimum return on investment that you're going to get. There's not much risk. It's almost guaranteed. Let's demonstrate what happens here when we move along the risk line and we move up the return on investment. So property and shares are seen, I suppose, historically, and I know there are so many variances within, for example, shares and property, to expect that the return could be 2, 3, 4% or as high as 20%, but let's just take an average, what you would expect. If you're going to invest in property or shares, there's probably an average return on investment in the Australian stock market of somewhere around about 10%. And you will see it in the property market, a similar figure, although it can come down for less risk property, low risk property, probably under 2 or 3 or 4%. I'm in this region of property and shares around about 10%. We're measuring risk, and that's what a clever analyst will do, measure this risk and ask the right questions and look at historical figures and look at the surrounding market and determine what risk they feel based on all the advice they can get, all the knowledge they can amass about that particular investment, that particular point in time, that particular location, all the surrounding circumstances. I'm prepared to take that return on investment for that risk. Now, this video is devoted to this area here. Your business. You are now saying to yourself, well, I can wait 72 years to get my money back, or I can wait maybe not so long but take a bit more risk, and I don't know what's going to happen with BHP shares or mining shares or gold shares or shares in retail funds or whatever. I don't know anything about that, but I do know that I can run a business. I know I can manage a business successfully. If it fails, it's on me. There's external factors all the time. We're just in the middle of a pandemic. No one can control that. You couldn't take blame for your business going bad by virtue of the pandemic. But here's where you have the greatest level of control. And most family wealths have been built from people who succeeded in their own business and were able to repeat that and grow that and build that, and either build that business or acquire more businesses to build a store of wealth in their own business.